All right, so here's what's in my stock market portfolio this week. So I've got this adjusted Apple Iron Condor, the low range being 200 and high range being 225. So as long as Apple stays within that range before or by May 17, then this trade is profitable. I've got AMD covered call position that I bought at 27.83. I sold a 26.5 strike, collecting 2.68. So giving myself downside protection in case the stock drops, but I still end up making a decent return of 5% in 4 or 5 weeks. Got Activision Blizzard that I bought at 44.7, sold call option at a 45 strike price, 2.48. And it looks like it's going to get called away if Activision stays above 45 come expiry date of May 17th. That's about a 5.5% return in 1 month as well. Got Bristol Myers. This one's expiring June 21st. It's a covered call trade as well. I bought the stock at 50. I sold the call option for June 21st a little bit too early because, as you could see, the stock went up afterwards and could have collected 89 cents instead of 36 cents. So I only collected 36 cents, which represents not even 1%, and that's on 2 months. So that's not pretty good. I've got cars.com that I bought at 22.8, sold at a 22.5 strike price for $1. So that's about 4% in 1 month as well. So Disney's an Iron Butterfly. This one's a losing trade. I still have to spend $400 just to close it. So this one's a pretty bad one. I've got Electronic Arts that I bought at 93.42, trading at 93.76 right now, but I sold a call option at a 93 strike price, collecting 4.84. Trying to collect about 5% as well in 1 month with this one. So Kraft Heinz is expiring May 17. This was 45 cents on a 36 price cost, but it was on 2 months. That's 1.2% in 2 months. But most likely I'm going to end up keeping my shares because the stock is trading at 32.77 and there's 2 weeks left. I can probably sell another call option this time. Hopefully the premiums will be higher. I've got Macy's that I bought at 25.82, trading right now at 23.2, but I sold it for 92 cents, giving me a 3.5% return in 1 month. I've got Mattel that I bought at 11.65, trading right now at 11.81, collected 65 cents. So that's about 4.5% in 1 month as well. This one's expiring May 31st though. I've got Micron that I just bought yesterday, bought it at 41.53. Stock is trading at 42.13. I sold at a 41.5 strike price. I sold it for $2.03, the call premium. So that's about 4.8% as well in 1 month. Got Six Flags, which will expire May 17. This was a call option that I sold for 2 months, so collecting $1 on a 54 cost. That's 1.8% in 2 months, but it looks like my shares will get called away come May 17 if the stock is trading above 55. It's close, so still hard to tell. Got Teva Pharmaceuticals that I bought at close to 15, trading almost at the same price, but I sold a 15 strike price, collected 88 cents in about 4 or 5 weeks. So that's 5.8% in a matter of 4 or 5 weeks. I've got a Tesla Iron Condor that I collected $85. I'm trying to close it out maybe for $20. Right now it's giving me a chance to close it for $50. So $35 profit after commission is not going to be worth it. So I'm still holding on to it. It expires May 24th. As long as Tesla stays below 305 and above 210, I can keep the full profit of $85. But I'd rather try to close it earlier. I've got Western Digital that I bought at 50.9, trading right now at 49.56. Sold it at a 50 strike price, collecting $3.04. And that's 5.2% in 3 weeks. I've got Weight Watchers that I bought initially at 30, sold covered call probably twice. But the last time I sold a call option against it, I went at a strike price that's much closer to the current market price. When it was trading at $17, I sold a call option at a 22.5 strike price to collect a higher premium. Because if I had chosen a $30 strike, the premium was much lower. But now there's a mistake. But now I'm at risk because the stock is trading at 23.14. So if come May 17 the stock is still trading above my strike price of 22.5, then my shares will get taken away at 22.5. But of course I don't want that because my cost is $30. So I might have to buy back the option. So I sold it for 45 cents, but I might have to buy it back at a higher price. As you can see here right now, if I wanted to buy back right now, it would be $1.30 just to keep my share so that I don't sell it at 22.5 and lose the difference between my purchase price and this strike price here of 22.5. So it's my mistake. I was a little bit greedy. I could have gone at a 25 strike, but I went for the 22.5 strike because the premiums were higher. But I could have gone at a 25 strike price and probably collected 25 cents or 30 cents. So right now I just have to hope that come May 17, Weight Watchers is trading below 22.5. We'll see. Got a bunch of United States steel trade. The premiums are so high. That's why I've bought them several times. So I've got one at a 15.5 strike price. I've got one at 17 strike price. And on each one, I've probably collected about at least 3% on the trade in 1 month. So I've got Zillow that I bought at 34.6, selling at a 35 strike price, collecting 2.65. So that's about 6.4% in a matter of 4 weeks as well. Then in my TFSA, I've got American Airlines, bought it at 32.5, sold a call option at 32.5 strike, collecting $1.09. So that's about 3.3% in 1 month as well. Now, of course, if I had just bought the stock at 32.56, I could have sold it at 34.75 and would have made 6%. So I would have made more than what I'm making on the call option. But of course, I don't know that's going to happen. At least this 3% that I'm making on the call option, I make it right away. Every month, I don't have to wait or hope that the stock moves a particular direction. So APHA.to, this one's hurting me. I bought it at 11.73 after it dropped from 17 to 12. So I thought 11 would be a good price to buy it at. Right now it's trading at 9.26. Regardless, I collected 90 cents from it. So that's 7.6% in 1 month. And when they expire May 17, I'll probably try to sell another call option. I won't be collecting 7%, but I'll still be collecting something respectable. If I go check for June 21st, I'll be collecting 20 cents if I pick a $12 strike price. If I pick an $11 strike price, I'd collect 25 cents. But I don't want to pick a strike price that's lower than my cost, so I'm going to stick to 12, collect 20 cents. Now, of course, it's not as good as the 90 cents I collected the first time, but 20 cents on 11.73 is 1.7% in 1 month. So I've got Bed Bath & Beyond that I bought at 16.5, right now trading at 16.3, collected 77 cents. So that's about 4.6% in 1 month again. Got CHK collecting 22 cents on 2.79. So that's 7.8% in 1 month. So IMGN is another problematic trade because I bought the stock at 5.7 initially, but I collected over $1 in call premium, probably $1.50, I believe, in call premiums. And then the stock dropped 50% or 40% as you can. Well, it dropped 50%. It was trading around 2.4. So I sold a call option at a $3 strike price, hoping that, of course, the stock doesn't surpass $3 come May 17, but it's already trading at 3.3 right now. So now there's a risk that I lose my shares at $3. And if that happens, well, my true cost is about 4.10 on this stock. So I'd be losing $1.10 per share. So a little bit over $400. So I might have to buy it back. I might have to buy back the call option in order to avoid losing $1.10 per share. So we'll see come expiry date what the stock is trading at. So that's why it's important to pick the right strike price when selling call options, even if you're going to collect a smaller premium. I've got more Macy's here that I bought at 24.17, right now trading at 23.2, but I collected $1.18 at a 24.5 strike. So that's a return of 4.8% in 1 month as well. I've got Neo expiring May 17, collected 49 cents on $5. So that's close to 10% in 1 month. I've got Sprint that I bought at 5.75, trading at 5.74 right now, collected 68 cents. That's about 8% in 1 month. I've got Square that I bought at 75, trading right now at 70, but I collected $5.14. It expires this week though, so I could probably go ahead and buy this back and then sell another call option at a 73 strike. So I actually collected the full $5 I get to keep, which is about 6%, 6.6% in 4 weeks or less. I think it's about 3 weeks. So if I wanted to actually buy back this option at 21 cents because I sold it for $5 and then sell the next month's option at the same strike price, I could just simply create order here. I'd remove the shares that here I have the option to buy back the option that I sold here, and then I can add another option, but this time I would sell, and let's say I'd go a month out, so June 7th at a 73 strike, I'd be collecting $1.70. So that's obviously not $5, but because the stock is not trading at 75, it's trading at 70. But that would be 2% in 1 month. Let's see if I go all the way out to June 21st. There's no 73 strike price. So yeah, let's go June 14, let's say, at 73, collect $1.90. So for an extra week, I get an extra 20 cents. So that's 1.7 divided by 73. So that's 2.3%. And finally, in my TFSA, I've got Teva Pharmaceuticals that I bought a little bit too high at 18.5, trading right now below 15. I sold it for 28. I sold the call option for 28 cents, but it was for 2 months out. So that's about 1.5% for 2 months or 9% per year. But as you can see, the options are trading for a penny. So I could probably buy back now and then sell the next month's option. But the problem right now is choosing the strike price. If I choose 18.5, I'm going to have low premiums again. Here, let's go see right now. So buying back the May 17th is going to cost me a penny. But then I want to sell, let's say for June 21st. See, there is no 18.5. I bought the stock at 18.5, so I have to go for 19. But then I'm wasting 50 cents because most likely the stock is not going to go back up to 19. So let's say I pick 18 strike price, which is lower than my cost. I'd be getting 4 cents, so that's really bad. Not worth trading. Let's see if I go June 21st, still nothing. If I go all the way out to September 20th, that's 41 cents. So obviously it's not worth it. What I'll have to do is either buy 100 more shares of Teva at this lower price of 14.89 so that my new average cost becomes lower. Let's say it becomes 17. So then if I go look at the 17 strike for June 21st, I collect 12 cents, which is not even a percent. Yeah, so this transaction here, this trade here is going to be a bad one. It's not giving me a good call premium to collect. So either I could buy more shares at a lower price so I can choose a strike price that's closer to the market price, or I can go further out, like 2 or 3 months, just to collect some decent premiums. So there's a good chance that American Airlines gets called away because I sold it at a 32.5 strike and it's trading at 34.75 right now, unless the market drops hard in the next 2 weeks. So most likely I'm going to get the cash available from this trade here when I get my money back, and I could probably use it to buy some more Teva just to fix it. Not sure yet, but that's a possibility. And finally, in my RSP account, I've got ACB that I bought at 10, trading right now at 8.88, but I collected 20 cents, which is about 2% in 1 month. The first month I collected 8%. So on average for the first 2 months, that's 5% per month. Got DFN.to and FTN.to for dividends. Got Honda Motor Company that I want to get rid of, just waiting for it to bounce a bit higher. Got L Brands that it looks like I'm going to end up keeping. It's trading at 25.6. Collected $1.50 for about maybe 5 or 6 weeks, which is 5.7%. I've got Novavax, which is like the IMGN trade, which was a pharmaceutical company that paid really high premiums. So I bought at 1.96, but I collected easily maybe 75 cents or more in premiums. So almost half of the price of the stock, but the stock dropped all the way down to 46 cents. So it dropped 76%. So the stock itself lost 76% in value. So I actually had to sell at a 1.5 strike, but I went all the way out to October to collect because I wanted to stay at a 1.5 strike. Of course, I didn't want to sell below my cost. So Vodafone was a stock that I bought initially for dividends, and then I tried to switch it to a covered call trade, and I had to go all the way out to December 20 just to collect something decent. Then I've got Yeti here that I bought recently at 35.4. Ouch, stock is trading at 30. I wasn't even aware of that. So I'm down $500 on the stock, but I collected a decent premium of 3.95, so it looks like I'm going to end up keeping all of that. I had chosen a 33.5 strike to give myself some downside protection, but the stock went even lower than 33.5. So regardless, I get to keep the full 3.95, which is 11% in less than 3 weeks. And let's say I wanted to buy back the options at 43 cents, the ones that I collected at 3.95. If I wanted to buy back at 43 cents to sell the next month's option, let's see what I can go collect. So let's go all the way out to June 21st. Let's pick a 33.5 strike price. Let's go to June 14, 33.5, because that's what I sold the first option at. So I collected $1.73 minus the 43, so that's $1.30. So $1.30 divided by 33.5 is 3.8%. So that's still very good. So even when the stock dropped 15%, I'm still able to collect 3.8% from the stock for the following month. So collected 11% the first month, 3.8% the second month. Still pretty good. So that's it for my stock market portfolio with Questrade. So if you have any questions, leave them in the comments section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video to get up to $250 back. And if you want to get my trades live, you can sign up to my WhatsApp group for $10 a month. I'll be sending my trades as soon as I place them on the market. And if you still haven't done your taxes and you're looking for an accountant, don't hesitate to message me. Link will be provided below. Thanks for watching.